job as a CEO and founder of a private real estate firm is not to find deals because there are deals everywhere in every part of the cycle, in every cycle in the real estate world. The job is to reject the bad deals. And a great capital allocator is essentially a professional that says no. We are no sayers more than we're yes sayers. And we're trained to be disciplined to reject about 99 deals to find that one good deal. And this episode is about the machine behind saying no. And I'm going to walk you through the funnel, the filters, and all the kill criteria and how we're choosing how to buy real estate, especially in today's market. Hi, everyone. I'm Ellie Perlman. I'm the host of Capital Insider. I'm also the founder and CEO of Blue Lake Capital, and we buy multifamily. We operate it with and we buy it with investors. We've been doing that for almost 10 years now. And I wanted to kind of walk you through what is going on behind the scenes and how we're buying. And if we're looking at kind of a funnel of about 100 deals, for example, so out of 100 that we see, many of them just collapse and become not relevant right away. And so essentially, whenever our chief investment officer, his team is looking at deals, most of them just die very early on. Before we even dive into the numbers, you don't even have to do many times back of an envelope because we know that sometimes, many times those deals don't work. So every time we're looking at deals, through the entire kind of funnel of deals in the markets that we're active in, we're asking essentially three questions. We're asking, first of all, is this the market I want to own in 5 to 7 years? Is the basis is right? Is it, meaning that's the second question. Is it replayable? Meaning, can I buy an asset below replacement cost, below what it would cost me to build a new building today, which is around $250,000. So there's really very little incentive to none to buy an older building at 250 or higher. So so the second question is, about the basis. And the third one is the story even making sense? Sometimes we see a declining, rent in a growing rent market. And sometimes we know that this is a management play, meaning this is owned by a mom and pop. We can come in with our professional team and improve operations and push NOI. On the flip side, if I'm seeing an asset that is owned and managed by one of the biggest real estate managers in the world, and we all know those names, and NOI is declining, and the story that the broker is trying to tell us is that you can push rents, sometimes I doubt that very much, because if with all the resources and all their knowledge and market dominance, they couldn't raise rents, they couldn't raise NOI, then the story just doesn't make sense. So these are the three questions. So most out of the 100 deals, I would say about 80 deals just die right there when we're looking at the market, the basis, and the story. And so out of those 20 deals, roughly 20 deals, we underwrite about 5. And this is where we put most of our efforts and resources into. So we're essentially pressure testing rent growth assumptions, expenses, capex, etc. And of course, the exit cap. So the question kind of shifts from could this deal work to what has to be true for this to work, and how many of those things we can control. So if we know that, for instance, we can put let's say 5.25%, 5.5% interest rate, fixed rate loan, then this is something that we can semi-control. But we want to make sure, okay, what happens if insurance costs go up more than we expect? Does this deal still work? What happens if if exit cap compresses versus stay flat? All these questions being answered during the underwriting analysis. And we're looking in IC, essentially, we're reviewing that investment committee that approves those deals. We're reviewing those assumptions and ask questions to make sure that if things don't go well, that this deal can still work, and it doesn't essentially depend on rents just growing year over year. Then out of those 5 that we underwrite, essentially one of those kind of passes the test, sometimes none. And this is the one that we are starting to compete for and send a letter of intent to the seller. So when we do that, many times we're more conservative on pricing. And if in the past, let's say 5 years and 7 years ago, my team would have underwritten a deal. Let's assume that the max we could pay is 55 million. Many times I would hear from brokers, don't even bother sending it. We have 25 other offers at 60 million or 57 million and above, and that's the starting point. And everyone is expected to leave some room for the second round of bidding, which is called best and final, and that would increase. And if your max is 55, don't even bother. Now we hear a very different story. I almost always get below the initial guidance of the brokers. Usually there's initial guidance, you know, 200,000 per unit, 180,000 per unit, 220 per unit. And even if we can meet that, they always ask us to submit the offer. And unlike years ago, most buyers they end up around the same pricing. So we don't see that huge gap. But out of those five that we underwrite, one we submit about 0 to 1, we submit an offer to. And some of them, we know we're far away from the pricing that we're willing to pay. And every once in a while, we would see a young group that is still willing to buy below 5% cap. And that happened, even in Dallas. In today's market, there was a deal that we know that traded at 4.7, 4.8% cap rate. And that was 6 or 7 months ago. So sometimes it's pricing that we just were not even close. And even though the broker is encouraging us to submit an LOI, many times we just understand we can be competitive. Sometimes there's some issues that during the DD, the due diligence that came up. For instance, that there's been, random fire that took down 2 or 3 buildings in the last 2 years. Other things that would make us kind of pause and feel like this is not the right investment for us. People think that our edge is the one deal that we buy, but it's not. It's actually the 99 that we don't buy. And the buy is just the residue of a lot of good no's, and we keep saying no all the time. So essentially low conversion is kind of a feature for us. So if you're closing, 1 in 5 that you're looking at, they're not being selective. You're just letting the market set your standards instead of setting your own. And saying no is kind of a second nature to us. The hardest no isn't the obvious kind of bad deal. It's kind of the deal that is kind of 95, 90% perfect with one fatal flaw. And the beautiful assets in the market with a supply wave coming. That's an example of a deal you should say no to. It's a beautiful asset, 2000 plus vintage. Even if you got it at a really good basis, because of the supply wave that is coming, and that's just an example, right, of a certain deal, you won't be able to renovate and get rent bumps because you're going to be competing with 2026, 2027 deliveries. And you're not going to be able to get rent growth. Those are dangerous deals. And they're dangerous because you're almost right. You might be getting 3 or 4% rent growth now, but in 18 months, in 10 months, when the 3 buildings around you are going to be built and delivered, this is where your thesis is not going to hold. And the 5% rent growth is just going to collapse to maybe negative 5%. So that's one deal that you should definitely say no to. So the instinct of kind of buying a beautiful asset in a strong market with an increasing, rents right now, it feels like a yes, it sounds like a yes, but it's not a yes. It has to be a no. So that's exactly also where FOMO comes in. And I kind of see FOMO as kind of the whisper that someone else is going to take it and the fear that you're going to miss out. And I have to admit, I have a few deals that I really liked in the past. And they always felt like the deals that escaped me. And looking back, it was actually deals that I should have said no to. I was forced to say no to because someone else overbid those deals. But FOMO is essentially the most expensive emotion in investing. Yes, I believe in making money through real estate, but the deal that you didn't buy, never lost you a dollar, right? So the deal you rushed into because someone else would grab it if I don't grab it, that's where the bodies are buried. And you really need to ignore the FOMO, but also ignore the greed. And these are two, and also the fear. So the FOMO and the fear, the two F's, are the ones you need to be extremely careful about not falling into those traps. There's always another deal. There's always another building, always another community that is going to be sold. And, pipeline is kind of like a river. It keeps flowing. It's not a lake. It's not a finite number of deals. So missing one is costless to you, and the market's going to bring another 100 deals in the next quarter. What you really want to avoid is overpaying. And many times you understand that you overpaid just looking back because hindsight is 2020. Always has been, always will be. But you still can look at some data but the true discipline is to say no when everyone else is rushing into buying it, but also on the flip side, saying yes when everyone is being cautious and being motivated by the other F, which is fear. Fear and FOMO are two bad emotions to motivate you to buy. With FOMO buying, you're gonna lose money or sometimes lose money. With fear buying, you're missing on the best opportunities that real estate can offer you. And you just need to look at the data and ignore those. So even the deals that I haven't done and I really like doing, I don't actually regret. I don't regret not doing it because the next deal that came was even better. So I'll give you an example. It was kind of the onset of COVID, early days, and it was a deal in Florida that I really liked, looked really good. We won the deal. And while we were negotiating with the seller, we learned that they're not going to let us into the units to conduct due diligence. And every time you buy an asset, you send an entire team. Usually it's 3 to 5 people. They go with a checklist and they walk each and every unit. Sometimes it takes 3 to 4 days because when you buy 300 units, you need to go physically get into each and every unit and inspect it to understand if there anything that is broken that you need to report back to the seller and get a credit or ask them to repair it. So you are being so at closing, you're going to get an asset that is well functioning and you don't need to spend money, fixing leaks and broken, pipes, etc. And the seller refused. And we said, listen, we're going to get in with team with hazmat suits. We're going to spray everything. We're going to give the 72-hour notice so the tenants will not have to be there. And the seller was freaking out and essentially said, you cannot walk any of the units. I'm going to give you, I forget if it was $1,000 or dollars per unit or $1,500 per unit as a kind of stipend in a sense. So if something breaks, you can tap that money. And this is where I said no. The numbers made sense. The deal was great. But buying something that will not be able, that my team is not going to be able to verify and vet the unit's kind of condition was not a risk I was willing to take. And so I said no. And I also said, I don't think anyone else will be willing to take that risk and buy an asset with hundreds of units without inspecting them. I actually don't know what happened to this asset if it was sold later on. But the next deal that came was almost 500 units in Atlanta in a different market. We bought it for about 80 million and we sold it for 110 million less than 2 years later. And that was a much, much better asset, better economics, better cash flow, 40 some percent IRR net to investors. Had some large investors that made, over 70% IRR on it. And it just turned out to be an amazing deal. And we were able to actually get with suits and inspect all the units. And it took, I think, more than 3 days with a larger team, but it was done. And so the not it wasn't fear that prevented me from doing this deal. It was just logic saying I'm taking too big of a risk. If this is a money pit and I can verify it, this is going to come out of my pocket, my investor's pocket. So I decided not to do the deal. Several months later, we bought the other deal. Um, so that's kind of an example of saying no when the story and the risk just don't make sense. Everything else checked out. It could have been, a great deal, but it was too much of a risk. Every time I remember this story, I kind of smile because it was annoying, but it ended up bringing me a much, much better deal because I stayed disciplined. Now, I want to say something about speed and thoroughness, because you really have to be quick many times to win a deal. And in a competitive market, you don't get to choose between fast from the beginning. Now, I want to say something about being fast and being thorough, because in a competitive market, you don't really get to choose between them. You have to be both. The funnel is what makes that possible. So essentially, when you want to be rigor in your analysis, when you want to go deep and make sure that you're making the right decision, it's important to do that at the right time. So, and when I say that, I mean that you need to be rigor, but also fast, and you can do it early. If you do it early, that's cheap because you can kill a lot of deals early on if you know exactly what to look at and you're not giving up on being rigor. And if you bring those kill criteria that you have later, that's going to be expensive. If you realize something that you could have realized early on when you're already under contract, spent tens of thousands of dollars on lawyers, that would be, pretty painful. So those kill questions, kill criteria, they have to come first. And we talked about, do I want to be in this market in 5 to 7 years? Is the basis good? What the supply pipeline looks like? Any kind of fatal physical, thing that I can find at the property that would make me walk away. All these questions we're trying to answer before we allocate any resources to underwriting, of course, putting the deal under contract. And you really want deals to fail fast and free, because this analysis, when you're early on, doesn't cost you anything besides, some more, I would say, hours that your employees are allocating towards it. At that point, it's kind of, sunk cost. So, the worst outcome is not losing a deal. It's spending 6 weeks doing due diligence, negotiating with the lenders, and with the seller, and spending money on attorneys, etc. And then finding out things that you should have found at the beginning and would have not cost you anything. So thoroughness is essentially the depth when it comes to the right questions at the right time. And, speed and rigor, they only fight each other if you're thinking after the deadline, after you've already could have gotten that information ahead of time. And we like to do a lot of our assessment, due diligence, and dig pretty deep early on. So when we get to the point where we're starting to spend money, we have answered all of those kill questions ahead of time. And yes, we gather a lot of information. We'll let the data speak to us. And I would say that real estate is a little bit of art and a little bit of science. And so there's always that. On one hand, you have data, you have the model, you have reports, etc. You have asset financials, but you also have intuition. And honestly, the cliche of trust your gut is kind of half truth when it comes to how you should be buying, of course, real estate, but also just trust the data and the model. That's also half wrong, because there's some things that the model cannot tell you. And so the starting point should be, yes, trust the reports, trust your spreadsheet and the underwriting for the magnitude of the data. So data is unbeatable when it comes to how much, meaning what returns am I looking at, sensitivity analysis, is the basis the right basis, whether the math survives a bad case, right? A bad outcome. Numbers don't have FOMO, and that's good, right? And when emotions are running hot, then the model is kind of the adult in the room and keeps you in check. But on the flip side, you can't just buy based on the model and let it make decisions for you. And so you still need to trust your intuition for data and questions that spreadsheets cannot see. For instance, if you talk to the broker and there's holes in the story, you are running a portfolio and in a certain market and you see that the market is shifting, whether it's positively or negatively, and it's not yet showing in all the reports because it takes time to gather that information. If the rent roll seems a bit off, maybe there's all of a sudden, or if you look at the financials, sometimes we're looking at it and their bad debt numbers month over month, and all of a sudden, 3 months prior to putting the deal in the market, bad debt disappeared or went down significantly. And in one instance, for example, we found out that the seller just decided to change their policy and now they're underwriting bad debt. They're essentially recording bad debt every 120 days. So it's in the market, it's on the market and you can't see it in the financials. Of course, you can look at the rent roll, but first view of the financials shows that there's no bad debt. So all these things, the model is not going to be able to tell. That's the gut that you need to involve and not to have involved in the process. And that's why it's part art and part science. It's part data, part intuition, and they both need to be combined. And when there's a conflict between them, the model wins when it comes to facts, right? The gut wins on which facts you need to gather. So many times you will see a conflict. And I can tell that I've looked into data back in 2022 that suggested a 10% rent increase year over year. Of course, I didn't use that because my intuition said that this is not sustainable and doesn't make sense based on all the knowledge that I've accumulated being, 20 years in the industry. And so the spreadsheet can say yes, but your gut is saying no. And many times the gut is spotting that risk that comes with years of experience that the model hasn't been told about, hasn't learned yet. Really, the right combination is to know when to lean on your gut, when to lean on the data, and have a perfect combination between the two of them before you make an investment decision. The gut's job is to ask the question, and the data's job is to answer it. The models, the reports need to answer it. The mistake is essentially letting either one of them dictate your decision making. So that's something to kind of, to keep in mind. And this is how I have been making decisions regarding investments in the last decade or so. The starting point was the model, the reports, the hard data. Then over the years, I added more and more of my gut that came from intuition, hearing brokers, speak, from looking at what's happening in the market and combining those two, that was extremely powerful. And it does take time to master it. It takes time to know how much percentage or how much weight to give to one over the other. There's no formula, right? This is real estate. And I think real estate is a very humbling industry and it keeps teaching you. And every year you learn something else. You can be in real estate for 500 years and still learn something. And every cycle is different. And the pain comes from an unexpected source. And the gain comes also from, and sometimes could be an expected source. And that's the beauty, but also the risk of real estate investing. That's it for today, guys. Thank you for listening. I'll see you on the next episode. Take care.